looking at the first section on macroeconomics now. So you'd have studied microeconomics as part of the AS course, actually Unit 1, looking at different market structures, oligopolies, monopolies, monopolistic competition, and also demand and supply. But this is a look at macroeconomics, which is the wider economy. So first of all, I'm going to start with interest rates. What are interest rates? Well, very simply, interest rates are just the price or the cost of borrowing or the reward for saving, and they're usually expressed as a percentage. So if you borrow £100 and the interest rate 7%, you have to pay £7 in interest on top of the money that you owe after, this would be an annual rate, so after a year. But if you put £100 in the bank and the interest rate 7%, you get £7 back on top of your amount that's saved in the bank at the end of the year. So when we're thinking about interest rates, it's quite confusing because there's actually quite a few interest rates, but primarily speaking, the base rate is set by the Bank of England. Now, although the name is Bank of England, it's not a lending bank as in, the NatWest or something like that. It's a bank, a central bank, that's what they're called, and they actually lend to other banks, and the base rate is the rate at which they lend to other banks. But the base rate is not the rate that businesses and consumers pay on their bank accounts or they get. So the interest rate that you pay, if you have a bank account, or you probably don't have debts, but more likely you've got maybe a few savings in your bank accounts, but the interest rate that you will receive is set by your bank. So there's no rule in the UK that everyone has to have the same interest rate. It's like shops, all the prices are different. You can shop around, get different rates. And this is Wonga, who offer payday loans, very short-term loans, and they annual percentage interest on £150. It's an 18-day loan, but if you kept it out for 100 excuse me, if you took that interest rate that you'd pay on the 18-day loan and kind of stretch it out to a year, the percentage rate is nearly 6,000% on 150. So you'd be paying much more back than the actual amount that you've borrowed, substantially more than you've borrowed. So the base rate is actually 0.5% at the moment, the rate that Bank of England set. But if you're borrowing money, you won't get that good a rate back. I've got a mortgage, and I think my mortgage is I've got quite a good mortgage, quite a competitive one, but I think it's about 2.45%. So that's because the bank wants to make money themselves. They're a business, and if you have a savings account with a bank, it's unlikely that you're getting 0.5% back on. Well, you certainly won't be getting it on your current account. You'll be getting less than that because, again, the bank wants to make money. They're a business. So interesting as that is, how does that affect business? Well, it can affect, I like to think of it as kind of a threefold effect. It can affect consumers, it can affect the cost of the business, and it affects investment. So if we just go through these each in turn. So if the interest rate increases, this means that it becomes more expensive for consumers to borrow money. It means that their mortgage payments get much higher, and it means that it's more rewarding to save as well. So demand in the economy for products, shopping products, decreases. Okay, so that would lead to decreased demand for a business's products. If a business has a loan out themselves, their interest payments will increase, so their overhead costs increase, so that's an impact on net profit. And investment, most businesses tend to have two forms of finance for investment. They have retained profit, but they usually have to borrow money to be able to invest. So, if you're going to invest in research and development or opening up a new production facility, you might not do that if the interest rate increases, because it makes the costs more expensive. So it might make the reward less when you're comparing it to the costs. So you'd carry out less investment. Whereas the opposite is true if the interest rate goes down. So it seems like, a smaller interest rate or a decreased interest rate is like a good thing for businesses usually, and that's usually what they'd want. I suppose it not be so great for the banks. They might not make as much money. But we can see the impact on consumer spending. What I've just told you was a little bit simplistic, because there are two types of goods, really, aren't there? There's the kind of products that you buy that are more luxury goods. So if your income went up, you buy more of them, this actually comes up in Unit 4 when you're looking at YD. So these are called normal goods. So they're called normal because they behave in a normal way. If your income goes up, you buy more of them. If your income goes down, you buy fewer of them. So definitely, holidays abroad to that lovely beach that looks very appealing right now, that would be affected by interest rate movements. But some products are necessities. They're either, necessities, so people have to buy them no matter if their income goes up or down, so food and shelter and water and those types of things. But also sometimes you get products that are called inferior goods, and that's not a judgment on the quality of them. That just means that if your income goes up, the demand for them goes down, and if your income goes down, the demand for them goes up. So we might find people switching from organic food and kind of posh ready meals to more smart price or value ranges as well. So it depends upon whether the good is a normal good or an inferior good, or whether it's a luxury or a necessity product as well. And also, different businesses are affected in different ways. So here, sorry, I couldn't think of a better picture. Gearing, it has an impact on gearing. So if you have a very highly geared company, which means that the money that's been invested into the business, a large proportion of it has come from borrowing. Long-term liabilities. So if you have a company or a business that's highly geared, that means they're more susceptible to interest rate increases. So there's more risk involved with them, and if interest rates go up, their overheads go up, and net profit would reduce, and the amount that can be distributed towards shareholders reduces, which is why shareholders, before investing, do work out the gearing ratio to see, how much dividends could be affected with an interest rate increase. Anything connected to the housing market, such as Homebase, they've recently had to close a lot of stores, is affected by interest rate increases and decreases, because the housing market is affected quite heavily by interest rate increases or decreases, because most people have to take out loans to be able to afford to buy a house. So therefore, if the interest rate goes up, that makes everything or buying houses more expensive, because your mortgage becomes more expensive. If the interest rate goes down, it makes it buying cheaper. So, places like Homebase or carpet companies or IKEA, they do well when the interest rate's a little bit lower. Mortgages are more affordable. Again, anything bought on credit, so you're going to be paying interest because you've taken out a loan for it, would be affected by interest rate increases quite heavily. And any products that are going to be exported to other countries would be affected by interest rate increases or decreases, or the price of imports and exports. I'm not going to explain that now, but I do explain it in the exchange rate video. So have a look at that if you want to understand those. So why does the government, it's really the Bank of England. Why does the Bank of England change the base rate? Because what I didn't say before was when they change the base rate, it changes banks' costs, because this is the rate at which the Bank of England will lend to banks. And therefore, you tend to find that their rates have to alter as well. They have to alter their prices of their loans and the reward they give for their savings accounts. So they're not kind of a proportional increase in the base rate or decrease in it will create a proportional increase or decrease in, NatWest rates, but they are affected by it, and they usually move in the same direction. So why does the government, cause all of this chaos? Why does the Bank of England cause all these problems for businesses by changing the interest rate? Well, the interest rate can be used to control the economy and to really control inflation mainly. And we're going to learn in another presentation that we want to be able to control inflation. So this is a policy used by the government called monetary policy. So if there's too much inflation in the economy, they'll increase the interest rate, and if there's too little, they'll decrease the interest rate. But we do go over that when we're looking at inflation. So we can see, we think, well, the interest rate is 0.5%, and it's been 0.5% for quite a while now, quite a few years, 5 years at least, 6 years maybe even. And you might think, well, why is it like that? And it does make sense if you look at the business cycles presentation as well. And it's because the economy's gone through quite a tough time recently with the recession, and hopefully we're into the recovery at the moment. But the Bank of England reduced, we can see here, quite a sharp decline in the interest rate to try and stimulate the economy, because remember, interest rates can affect demand in the economy. So when demand dropped because we went into a recession, to try and stimulate it, they reduced the cost of borrowing. So definitely helped and was better than keeping it at the 5% that it was just before it dropped. But didn't cure all the problems, because we had quite a prolonged recession, a deep recession.